Hey everyone, welcome back to another episode. Trading with naked price action stands out as a powerful method because it helps you anticipate market moves by concentrating on the one element that truly matters, price. In this video, we've compiled some of the most effective price action patterns and methods we've discovered through years of hands-on trading experience, which have consistently proven to work. Today, I'm going to walk you through how to recognize these setups on the chart, explain the psychology that drives them, and show you how to apply them to make smart, data-driven trading decisions. As always, don't forget to hit the like button to support the channel, and subscribe if you're new here. We regularly share high-level trading content. Welcome back, and let's dive into the first price action signal, the inside bar confirmation. Picture a ranging market, where price has been moving sideways within a confined zone. Suddenly, price breaks out and closes above the resistance level, signaling that buyers have gained control over sellers and the market may now trend upward. But how do we confirm this breakout is genuine, and not just a false move or market manipulation? Because price can easily snap back into the range and resume moving lower. One way to confirm the breakout is by waiting for a pullback followed by a rejection, suggesting that the broken level will hold. The challenge, however, is that this pullback might never happen, and we risk missing a strong long entry setup. This is where the inside bar confirmation becomes useful. An inside bar is made up of two candlesticks. The first is known as the mother bar, which is wide and dominant, followed by a smaller candle that forms entirely within the range of the mother. This pattern signals market hesitation. In an upward trend, it shows that buyers are taking a pause. The second candle, usually a small red one, appears after a strong bullish move. In contrast, during a downward trend, it suggests that sellers are losing momentum, shown by a small green candle appearing after heavy selling. So how does this pattern help us evaluate whether a market structure breakout is reliable? When an inside bar appears following a market structure breakout, it represents a brief phase of uncertainty. If the price then breaks the pattern to the upside, it indicates that sellers attempted to drag the market back into the previous range, and failed. This serves as added confirmation that the breakout is legitimate and that there's a greater likelihood of continued upward momentum. For example, on the US 31-hour chart, the market rejected the same resistance zone twice. Eventually, price breaks through it and forms an inside bar pattern, signaling that sellers are again attempting to push it below. However, if the price breaks above the mother candle's high, it suggests that buyers have regained control, validating the breakout and increasing the probability of further upward movement. Now let's move on to the second price action signal, fakeouts. A fakeout, also known as a failed breakout, takes place when price breaches a key structure level but quickly reverses and falls back into the previous range. Picture an uptrend where the market pushes beyond a resistance zone. Typically, we'd expect this area to act as new support upon retest, leading to a bounce. But if price cuts straight through it without hesitation, this is known as a fake out. It often reflects strong momentum building in the opposite direction and can be an early indication of a potential trend reversal. On the Bitcoin 15-minute chart, we recently saw a break below a support level. Naturally, we expect this zone to act as resistance and push price lower. However, when this resistance fails and price re-enters the previous range, it signals strong buying pressure, suggesting the potential for price to keep climbing. Shifting to the 1-hour chart, we notice the broader trend is bullish, as price has broken above a key structure. By combining the higher time frame trend direction with an entry trigger on the lower time frame, we can anticipate a bullish move. Over on the gold 15-minute chart, there's another example of a fake out. What makes this one notable is that it occurred after price tapped into a demand zone from the higher time frame. This gives us dual confirmation that the short-term bearish move has likely ended, pointing to a possible reversal. Still, always practice patience. If a setup doesn't meet your trading criteria, it's okay to skip it. Now, let's move to the next signal. But before we do, if you want to see more content like this, don't forget to show your support with a like and a comment. Number 3. Double top and double bottom entry. This is a widely recognized M-shaped reversal setup often used by price action traders. A double top pattern forms when price fails to establish a new high, typically signaling issues like a loss in momentum, a shift in structure, or interaction with a major level on a higher time frame. The most cautious way to trade this setup is by waiting for a break of the neckline to confirm the reversal. However, entering after this break often requires a large stop loss, which isn't ideal. A more practical approach is to wait for price to return to the neckline and look for candlestick rejection patterns as an entry trigger. But this can also mean missing the trade if no clean candle setup appears. So here's our method for trading the double top and double bottom. We pair it with the 0.618 Fibonacci retracement level to refine our entry. After the neckline break, we apply the retracement tool, found under the IND Indicators tab, from the beginning to the end of the move, and set a sell limit exactly at the 0.618 retracement. Now, some of you have been asking in the comments, trade like Assad, how do we know where the move ends when drawing the retracement? The honest answer is, we don't always know. If price continues pushing, just update the retracement tool based on the latest swing. And if price hits your target before a pullback even happens, then it's better to skip the trade altogether. The same logic holds true in a bearish setup. Price rejects a zone twice and confirms the pattern by breaking above the neckline. We then apply the Fibonacci retracement tool and set our sell limit around the 0.618 retracement level. The stop loss should be positioned just below the swing low, and our take profit would be at the next significant market structure level. But here's a key insight: trading every double top or bottom that forms randomly in the middle of nowhere isn't a solid strategy. A better approach is to identify higher time frame key levels where price has shown multiple rejections, and then wait for double top or bottom formations in the lower time frame for confirmation. Looking at the EUR1 United States dollar-hour chart, we can see a significant market level that has acted as both resistance and support multiple times. I'd wait for price to move into this supply zone before scouting for a double top formation to catch a potential short setup. Now if we zoom into the 5-minute chart, we observe that a double top has occurred, and price breaks below the neckline. We apply the retracement tool from the start to the end of this move and place a sell limit at the 0.618 level. Stop loss is set just above the swing high, and our target is the next nearby support zone, giving us a risk-to-reward ratio of over 1 to 2. That said, this setup isn't restricted to only one method. You can use additional price action confirmations to refine your entry, such as this long wick rejection candle. But the key takeaway is this: to build trust in your strategy and refine your edge, it's essential to backtest your setup across different pairs and scenarios. Shrinking candles describe a price action behavior where the size of the candle bodies progressively decreases as price approaches a supply or demand zone. In this chart example, we can see the price moved upward, touched a key resistance area, and then reversed. Pay close attention to how the candle bodies reduce in size while approaching this zone. The reasoning behind shrinking